Hi, Jeremy Serrier here from CRA Invested. So, welcome back to Module 4. What we're going to be talking about in Module 4 is actually leveraging debt. Module 2, we talked about your strategy and your why and really forming a framework for what your core motivation is for investing in commercial real estate, as well as setting your target parameters. Module 3, we talked about your financial target. We went through several measures that you can use to build a target in order to find out when you see that deal whether it actually fits for what you're looking for or not. So once you've done those two modules, we're going to move here into Module 4 and talk about leveraging debt. Now, leveraging debt in a nutshell really is about what you can do using other people's money. And the concept of leverage in and of itself is the use of borrowed capital to finance the acquisition and or the operation of an investment with the goal to increase buying power and potential profit. So just for a moment, what I'd like you to think about is imagine yourself trying to change a tire on your car. You've been driving down the road, you get a flat, you pull over, and you get out and start working on the tire. Now, you're not going to sit there and try to lift up the vehicle with your own two hands because it's going to be too heavy. It's going to be too much to move. So what you're going to do is you're going to go into the trunk and you're going to take out a jack. You take the jack out, you put it under the car, and with a little bit of effort, not much, but a lot less than you were trying to exert to lift the car in the first place, you're able to get the vehicle up off the ground so that you can change that tire. What you're doing is more with less, and that's in a nutshell what the concept of leverage really is. So in this module, what we're going to talk about as our agenda is the concept of leverage in and of itself. We're going to calculate loan amounts. We're going to talk about mortgages, owner financing, hard money, and transactional funding. We'll touch on assumptions and we'll go into recourse and non-recourse debt, and we'll talk about raising equity. So leverage, some examples of what leverage really is. It's all around us all the time. There are mortgages that are issued by banks, private investors, owner equity. Bonds are a form of leverage. Syndicated equity or debt is leverage. Private money loans, commercial mortgage-backed securities, conduit or correspondent loans. So when you're working with leverage, one of the things that you want to make sure you do when you're targeting is factor the cost of borrowed funds and equity into your target. Now, in Module 3, we did some work with cash on cash, and we did some work with annualized returns and target cap rates, taking leverage into consideration. So you want to make sure that you're looking at that, because the amount of debt that you use and how much money it costs you when you're actually investing in commercial real estate is going to play a very, very important role in terms of the experience you're going to have, how much money you're going to make, or how much you could potentially lose. So with leverage, you'll pay returns to lenders and investors who participate in your deals. They'll leave you ideally with returns that meet your financial target. So you want to make sure that you have a very good understanding of how much leverage you're using and what it's costing you. The concept of leverage is essentially a time value money calculation, and what you're doing is you're asking yourself four key questions. How much money are you borrowing? When are you borrowing it? How much money are you paying back, and when are you paying it back? And these components are broken down into 5 time value money components. You have your initial investment, the time period, the payments, the interest rate, and the future value. Each of these components are broken up into abbreviations that you'll see. You'll see PV for that initial investment. That's that present value investment. N represents the period or time period that you're taking the debt out for. Payment is represented by PMT. Interest rate is represented by I, and future value by FV. So let's take a look at a sample problem and see how this works. In this case, you have a $1.5 million loan that's amortizing over 25 years. You have monthly payments at 5% interest. So the question is, how much are your payments going to be? Well, when you break out each piece of this question, you'll see that your PV is 1.5 million, your N is equal to 25 years, or 25 times 12, which is 300 payments. Your PMT is unknown, so we're solving for that. Your I is equal to 5, or 5%, and your FV equals 0. Remember, you're holding the loan for 25 years and paying it off, so you're going to have a 0 balance when you're done. What we do is we enter these numbers into our calculator and we solve for PMT. And in this case, we get $8,769 a month, or $105,226 per year. Now, if you'd like to follow along and solve these sample problems while we're going through them, you can go to tab 8 of the financial targeting tool and enter this information into the mortgage payment calculator and solve for these individual components. Sample problem 2. You need a loan that has monthly payments of $5,500 over 20 years with monthly payments at 6.25% interest. So how much money do you need to borrow? This is the kind of question that you're going to run into when you're trying to solve an owner financing problem and you're focused specifically on cash flow. You want to know how much cash flow you can afford to have left over if you're paying to borrow money. And as you do that, you're going to be structuring terms, but you also need to know how much PV, or initial investment loan amount, you're going to need. So to solve for that, we'll take our number of periods, which is our 20 years, we multiply that by 12 to get 240 payments. Our payment, we know, is $5,500. Our I is 6.25%, and our future value is 0. Again, the loan is paid off at the end of 25 years. So we enter that information, we solve for our PV, and we come up with $752,468. Sample problem 3, when we're solving for the interest rate. You're now offered a $3.5 million loan over 30 years with monthly payments of $18,258. What's the interest rate you're paying? Well, we take the information and we go ahead and load up our calculator. Our PV is 3.5 million. Our N equals 30 times 12, or 360 payments. Your PMT, or payment, is $18,258. Your I is unknown, so we'll leave that out, and our future value again is 0 because we're holding the loan for 30 years and paying it off. So when we solve for our interest rate, we come up with a rate of 4.75%. Sample problem 4, solving for the number of periods, and what we're trying to figure out is how many years we need the loan to amortize. You want to borrow $1.25 million at 5.65% interest with monthly payments of $7,788. So how many years should the loan amortize? Well, you take your PV, that's that $1.25 million that you're borrowing. Your number of periods that's unknown, we're solving for that. Your payment is $7,788. Your I is 5.65%, and your future value is 0. Now you remember, if you're entering in payments and it has to be in years, you're going to need to multiply that 7,788 by 12 to come up with your annual payments on the loan. Once we do that, we solve for N, and we'll have a 25-year or 30 or 300 monthly payment solution. Sample problem 5, we need to solve for our future value, and that's the amount of money we owe at the end of the loan. So you want to borrow $1.25 million at a 5.65% interest rate with monthly payments of $7,788. The loan amortizes over 25 years, but you have a 5-year term or balloon. And that means that the bank has asked you to come back and they'd like you to pay off that loan in 5 years. So you're going to have to either refinance or sell. Now you remember in Module 2 we talked about problem targeting. This would be one of those problems that an owner might face using that 4-6-9 rule that we discussed. So the question here is, what's going to be owed? Well, you take your PV, that's $1.25 million. Your N is your number of periods, that's 25 years or 300 monthly payments. Your payment is $7,788. That's your monthly payment. And your I is 5.65%. We're solving for our future value. And one of the things that we've got to do here is that we have to make sure that after we've entered that information, we change our N to equal 60 monthly payments or 5 years in order to solve for the future value. And that's that 1.18 million number that we just came up with. So according to this problem, that's how much money we owe when the loan is paid off. Now there are two ways to calculate a loan amount. You can calculate a loan amount based on loan to value, which is very common. You'll see 75%, 80%, 90%, 60% loan to value that's offered by a lending institution. You also see what's called debt service coverage ratio. what lenders like to do is offer you the minimum of the two. So loan to value is a percentage price offered by the lender, and they tend to avoid loans with very high loan to value because they don't want to be exposed on their debt position to too much fluctuation in the valuation of the property. Debt service coverage ratio is the ratio relationship between your net operating income and your annual debt service. Most lenders like about a 1.25 debt service coverage ratio. You'll see them range. You might see them down to 1.2 or as high as 1.4 or 1.5. It depends on the type of property you're investing in. What this means is that for every $1.25 you collect in net operating income, $1 is paid toward your annual debt service. Your remaining 25 cents serves as your cash flow and buffer between operations and annual debt service. So what I'd like you to do is go in and work on exercise 4.1 where you're going to solve for the loan. So now that you've finished exercise 4.1, let's go ahead and dig deeper into this debt service coverage ratio calculation. The way this works is you take your net operating income, you divide it by your annual debt service, and that gives you your DSCR, or debt service coverage ratio. So in real numbers, you have an NOI of $125,000. You divide that NOI by 100,000, and you get a solution of 1.25. So when you're solving here, we're going to just go ahead and do a problem. Let's determine the loan amount on a property with the $125,000 NOI. You have a 1.25 debt service coverage ratio, 5% interest rate, monthly payments, and it's amortizing over 25 years. How much could you borrow? Well, we know our PMT is $100,000. We're going to divide that by 12 to come up with $8,333 a month. Our N equals 25 years or 300 monthly payments. Our I is 5, and our FV is 0, because remember, we're holding the loan for a full 25 years. So we're going to solve for that PV. We come up with 1.425 million as our solution. So a note to borrowers, this is something you want to be really careful of. Lenders will select the lesser of the loan to value and debt service coverage ratio number. So even though you might have a property that you're purchasing at a great price and you want a high LTV, if it's not producing a quality or stable NOI, the lender may penalize you for that by assigning a debt service coverage ratio calculation and give you the minimum of the two. Let's talk about owner financing. Now, here's how it works. Owner financing involves finding sellers with equity, and these sellers agree to finance all or part of the purchase by lending you their equity in the form of a mortgage or a promissory note. Many owners struggling to sell troubled properties will offer owner financing, and just because you see an owner willing to carry it does not mean it's a deal. A lot of owners are really savvy, and what they know is that they can sometimes achieve a higher sale price by offering attractive owner financing to you in order to get you to come in and pay them a bigger number. And sometimes they'll even set you up to fail where they'll try to sell you a property for too high a price, offer you financing, get your down payment money, and when you can't afford to operate the property anymore, they'll take it back and then do that again. Don't make that mistake. So one of the things that you're going to do by having completed modules 2 and 3 with your targeting is you're going to be able to run your analysis to see whether the property fits your target or not. And if it doesn't, don't fall into the trap that just because the owner is going to carry paper, you'll be fine on it. So here are a few structures that come into play when you're dealing with owner financing. You can have a first mortgage, and what that looks like is the seller will have all equity or they'll have a small debt to pay off. If they have a small debt to pay off, they'll actually ask you to make a down payment equal to or greater than that number so they can go ahead and pay off their prior loan and then take the balance of the equity and lend it back to you as a first position loan. They'll originate that just like a bank would, and the mortgage is recorded at the registry against your new property. And here's a little picture of what it looks like in the capital stack. The capital stack is a combination of the debt and the equity that you have in the property. So the green section in this bar represents the first mortgage. That's the money that you're borrowing against the property. So in this case, you're buying $1 million property, 70% or 75% of that, or $750,000 of that you've borrowed, and the other $250,000 is represented by your down payment. Now when you do a second mortgage, here's where things get a little interesting. Typically the seller has a smaller equity position and a larger debt to pay off, The seller originates a second mortgage and promissory note just like a bank. The mortgage is recorded at the registry against your new property in second position to the bank's first mortgage. So you've gone out and bought this property, you've borrowed the first portion of the mortgage from the bank, and you're going to the owner for the second portion. This allows you to put less money down as long as the bank approves the seller's second position. So here's how it looks on a capital stack. Now before you had that $750,000 debt position for that first mortgage. Now you have a second mortgage. That sort of pink or salmon colored band represents that second piece. And that's stacked on top of the first mortgage. Then you have your down payment number on top of that. Now one of the benefits there is that you can go ahead and leverage the property a little more highly and put down less money. And in some cases, in some cases, you can go out and actually get a third mortgage. And that third mortgage would go on top of the second. And what ends up happening is you reduce your equity position substantially by each amount of debt that you're able to layer on that first position. The thing to remember though is when you go to sell that property, you are going to have to pay off those loans in order. So first, second, third, and then you get paid. So while you may be sitting at the top of the capital stack, that also means that you're going to be the last to get paid when you sell the property. So here are some pros and cons on owner financing. Pros are it can be fast, simple, doesn't appear on your credit, lower fees, no banks involved, and flexible underwriting or down payment. The cons are that a lot of properties that I see that are owner financed are often overpriced. You need to know the terms that you can afford to pay going in. And when you do your financial targeting, you're going to have an idea of what kind of loan you can take on and still hit your financial measure requirement. You're also going to have owners that are very savvy and may take advantage of creating that type of scenario for you. And there may be that former owner in the background. So they may not go away. They're going to hang around and they might be pestering you about how you're operating their old building, but still feel that they have a connection to it. Hard money is another option. It's called hard for a reason. It's relatively easy to find, but it's hard to pay back. Most hard money lenders are looking for anywhere from a 12 to 18% return on their investment. That's a pretty steep amount of money to pay. So you want to keep that in mind. It can be expensive, and it's often designed for your failure so that the lender may actually come in and loan to own the property. So you want to be careful. High interest rates are common with hard money, low loan to values, and a lot of fees. So a common structure you might see would be a hard money lender coming in and saying, we'll give you 50% equity or 50% debt here, and you'll provide 50% equity. We're going to charge you 12% interest and 3 or 4 points that you're going to pay on top of that. That's a pretty expensive debt, and I'd really encourage you to look at it as a last resort if you are going to be using hard money. Transactional funding. This is a funding source you can use to close and flip. It operates like a line of credit. It can be expensive, and you want to decide whether flipping fits your financial target or not. It may be easier and less expensive just to assign your contract and take a fee versus bringing in capital, taking title, and then flipping the property quickly. Loan assumptions are another option for leverage. Some commercial loans are assumable, and they present great opportunities to skip loan origination. When you're looking for assumable financing, you want to be aware of the following. You can oftentimes get stuck in an above market interest rate deal. You may find a fantastic opportunity where you've got a tenant paying for the next 10 years. The loan happens to be assumable, but the interest rate's higher than what it would be today in the open market. But unfortunately, you have to assume that loan in order to buy the property. That could actually be detrimental to the value of it. You can also run into high assumption fees, where a lender may charge you a point or two to assume a loan, high prepayment penalties, yield maintenance clauses that you can get trapped in, and a high loan to value that destroys cash flows. So you want to be careful there on assumptions. Just because you can step in and take over debt doesn't mean it's necessarily a great deal. What you might want to look for if you are examining those opportunities is try to find non-recourse assumable debt. Those types of loans will allow you to get out of personally signing for the debt in some form or fashion. The recourse side of things does allow the lender to pursue you personally, and unless you have carve-outs or exclusions in that recourse, they could come after your personal assets as well. So most lenders will seek some form of recourse to reduce their risk and exposure in the event of your default. Non-recourse is great because it's guaranteed by the property. The bank may only take the building and not pursue you for losses, and most lenders will charge a higher rate and do not like to offer non-recourse financing except to premium borrowers. So if you have the opportunity to get non-recourse, grab it, take it, use it. If you can assume it, that's good as well. But just make sure it fits your financial target and it's accomplishing what you're looking for it to do. Don't take it just because you can. If it's not working for you and it's not getting you to where you want to be, don't waste your time with it. Now here's a tip for you when you're dealing with owners and non-recourse. When you're arranging an owner financing deal, try to make it non-recourse. Some owners may think to ask you to sign personally, but sometimes you can get out of that and just say, well, my company will be borrowing the money and it will be recorded against the property. So that way they just have collateral, they just have the collateral or the building that you're buying backing up the loan and not necessarily your personal balance sheet. When you're going out to raise equity to leverage your deals, you can use partnerships to do that. You can use them to raise equity by splitting ownership and management of the property. Most investors will use an LLC to manage the partnership formation and capital contribution structure. You may actually have a number of structures to choose from. There's no one right way to do it. It's going to be case by case and what works well for you. And the best sources of partners are typically other investors, friends, family, and professionals looking to participate in your deals. Getting into the syndication side of things, you can syndicate equity by raising money from friends, family, and your network. If you choose to syndicate, make sure that you comply with SEC regulations and realize that you're now entering the investor relations business. Raising equity can be mistaken with selling securities, so do be careful about that. One of the things that I recommend you do is contact us at CRE Invested for more information on creating a fund or syndicating equity. And what we'll do is we'll connect you with professionals in the marketplace who specialize in syndication formation and compliance. I want to make sure that if you are syndicating, you're doing it legally. And if you're concerned about that, please do contact us. We will connect you with the appropriate professionals who can help guide you through that process to make sure you're doing it correctly. And you can email us at creinvested.com. So that's it for leveraging debt. Our next session and what's ahead, we're actually going to talk about how to work with brokers. So now that you have your strategy and your why, your financial target, and an understanding of what your debt parameters will be and the types of leverage that's available to you in the market, best place to start is calling the brokerage community. But here's the thing. I want you to sound like a pro when you call them. You don't want to call these guys up and sound like every other investor that calls a brokerage company. Don't make that mistake. So in Module 5, what we'll do is we're going to teach you how to sound like a pro. You're going to learn what not to say to brokers. You're going to learn about how brokers get paid, what to look for in a broker, designations, and I'm going to give you a sample representation form that you can actually present to brokers to get them motivated to help you find the deals you're looking for. And what you're going to find is that when you call these people and you have a very clear description of what your strategy, your why, your financial target, and your debt scenario looks like, they're going to be quite receptive to hearing from you. And with the tools and the scripts that I'm going to give you and how to talk to these brokers, you're going to find that they'll be very open to helping. And if they're not, they're going to try to find the people who can help you find what you're looking for. So thank you. This is the end of our Module 4 on leveraging debt. I look forward to seeing you in Module 5 and learning about how we can work with those brokers and get them sending you deals fast.